welcome to our February meetup. Glad to have you here. We're going to give it a few more minutes and we'll be getting things started. My name's Bobby.
Can you hear me now?
Yeah, I can hear you now. There we go.
Oh, perfect. Yeah, I think it was something here that I just clicked. I'm glad I just got off from work, I think that I spoke to you a while back.
Yeah, I thought I recognized your name.
Yeah, but I could not actually follow up with you because I got this locum work here in Ohio, so I have to relocate from Florida to Ohio.
Gotcha.
Yeah. So.
Well, no problem. I'm glad to have you here.
Yeah. I saw today on Facebook that I put a link.
Yeah.
And then I decided to follow up with you because I have some spare time today.
Oh, absolutely. Yeah.
So what kind of properties do you invest in?
So I am invested in 6 different multifamily properties. So 6 different apartment investments. So 2 of them are in North Carolina. Those are both Class A properties, and in the 150 to 250 unit range. And then
what city?
I'm sorry.
Which city do you invest in? Which city?
Hold on. Oh, I've got one in Raleigh, and then the other one is in Lake Norman.
Oh, okay.
So.
Oh, cool.
Yeah. So that's kind of what I've got going on there. And let me admit somebody else. So
I don't have a camera, by the way. Sorry,
that's okay.
I know some people they don't like to, but I don't have my camera doesn't work on my computer. I apologize for that.
Oh, no problem. We have meetings with people who aren't on camera. Sometimes we'll have people who, they've got their retainer in and they're in their PJs and they're ready for bed. So they're like, I don't want to be on camera. So, but yeah, so I'm invested in 2 other offerings that are in South Carolina, and those are a bit smaller. One of them's a 55 unit. The other one's I believe it's a 70 unit or no, it's an 80 unit. I apologize, 82 unit. And so those are B minus C plus properties. So a little different. They're more of kind of a fix and flip aspect to them, but just bringing them up to better standard and making sure that they're in that B class. And then I'm invested in one out in Colorado Springs that's an A class, and then another A class that's out in Boise, Idaho.
Oh, okay. All right.
So.
And you invest by yourself, or you have a group of people that invest together?
So yeah, I'm what's called a limited partner on all of those.
Okay. Oh, okay.
Hi, Catherine.
Hello, how are you doing?
Doing well. I hope you are.
Yeah, I am. This is actually perfect. I just saw your posting like 45 minutes ago. My partner and I were just talking about this morning about like passive income and like what we want to do in the future. So I showed him and I was like, well, we're on the West Coast. So I was like, it's in 45 minutes. I'm gonna hop on.
Great. Yeah, well, glad to have you. So I'm just kind of going over some of the investments that I'm in. Quick recap, I'm invested in 6 different properties across 4 different states and passively in all of them. So I'm what's called a limited partner. So you've got the limited partnership, which are the passive investors, and then you've got the general partners who are the kind of the boots on the ground. They're the ones that put the deal together, do the heavy lifting and all of that. So that's the general partnership. And so right now I'm invested as a limited partner. So I put in my money and then I get the passive income in return. So and it's worked out wonderfly so far. I've been invested about a year and a half, well, more than a year and a half now. But yeah, it's been great. You get the checks either on a monthly or quarterly basis. And of course it's dependent on how
Mhm.
much you put into a deal. But, you know, and my investments range from 50,000 to, you know, 115,000. So I actually took some, funds out from my retirement accounts, and with the idea that I would be producing passive income with this. And, but then my wife's also invested in a couple of deals inside of her retirement accounts, which is a cool thing.
Okay.
So,
Yeah.
well,
How
welcome,
did
Courtney.
you come across these like opportunities?
So, the way that I got started was, through podcast listening. And, I happened to be listening to the Michael Blanc podcast, and a fella came on there because Michael Blanc talks a lot about being pretty active with apartment investing. And so, he had a guest, by the name of Ryan McKenna, who runs McKenna Capital. And, he's actually more of a capital raiser for different, offerings. And so I reached out to him and started getting involved in some of his deals. I also met other operators as I went along my path in this field. And, so I've invested, with them as well. And so it just, it's been finding people that I trust, and finding operators that I trust, because at the end of the day, a deal can look great on paper, but if you don't have operators that are actually able to carry out the business plan that they've set forward, then, you know, you're kind of setting yourself up for failure. So, and especially now, as you know, cap rates are kind of compressing a little bit. You know, the interest rates are remaining low, which is really good. You can get cheap loans, you know, but it's still, there's a lot of competition for a lot of deals out there. So it's something that you have to kind of, you want to have operators that have been there and done that. They've been through some of the leaner times. They know what they're doing, you know, when times get tough, and they can adapt, to whatever's happening, because they've been through something similar before.
Got it.
So, but yeah, I'm, you know, any questions that you have, I'm happy to answer. You know, anything that you're looking to find out about it, you know, I'm happy to be a resource. So whatever you guys want to talk about.
So how are you investing with your other partners? Are you like you just mentioned that you I forgot the terminology that you just say.
I'm a limited partner. So basically the best comparison for that is, you know, if you buy stock in Amazon, for say, you know, when you buy that stock, you're not going to go in the next day into the board of directors meeting for Amazon and start calling shots, right? You're buying the Amazon stock because you have faith in the current board of directors to continue making that stock worthwhile, to improve, you know, either your stock price or the company's performance, right? And that they're going to take care of their shareholders. You're investing in the business. And that's what this is like. Apartment syndications are essentially investing in a business that is running, an apartment complex.
Okay.
So, but the nice thing about that is that you get, all of the benefits of owning real estate from that. So, welcome, Courtney and Jeffrey. Feel free to jump in whenever you'd like to, and, any questions that you have.
How much are your returns on your investment?
So, the returns are pretty stable from a, 6 to 8%, cash returns, cash distributions that you get. So, you know, for instance, if you put $100,000 into a deal, you can expect that you're going to get $6,000 to $8,000 of cash flow in distributions from that investment every year. So oftentimes those are kind of, they'll be a little bit lower in the beginning, and they might you know, go up as you get on, a few years on. So, for instance, you'll start off at 6%. Then the next year you might be at 6.5. Then the year after that, it's 7. It all depends on the deal, and how they have it structured. Some offerings are more of a cash play where, okay, well, from, the moment we start paying distributions, you're going to get 8% cash returns, and that's where they're going to be. But some others are, when you have some of your heavy duty fix and flips, they need that capital in the beginning to actually fix up the property. So they don't want to be taking in capital and then like shelling it all out to these shareholders, to the limited partners, when they need that to actually do the parts of their business plan that make money, and improve the units and allow them to increase rent. So sometimes you'll have deals where you start getting paid within 3 months. Others will wait for a year before they start giving out distributions. Some deals will give you that higher cash return throughout the investment. Some will do lower cash returns with the anticipation of a higher sale price where you make more of your money on the sale. So it really just depends on the offering that you're looking at and what the intentions are.
Okay.
Good question. Did that clear it up?
Yeah, definitely. Yeah.
Okay, cool. So,
So you receive that 6-8% cash flow a year, and does it come out over monthly payments?
Yeah, so
Usually, or no?
it depends
usually...
on your operators, whether they pay on a monthly or quarterly basis. So I've got 4 of my offerings are monthly, 2 of them are quarterly.
Okay.
So you can set that up and you can kind of, it can be staggered or however you want it, but it just depends on the operator you're working with. So some of the, what I was talking about earlier too, were some of the benefits of actually owning. You get the benefits of owning real estate, even though you're actually investing in an LLC, a company. So you get the depreciation on the property. That's a big deal for helping you to lower your taxable income, because you can get what's called, you can do a cost segregation analysis of the property, and you can get bonus depreciation. So, in a typical house, when you purchase a single family home, you can depreciate that home over 27.5 years. All of the interest and everything, but you have depreciation in that home for 27.5 years. What the laws have allowed us to do with apartment syndications is you can bump that up and take that full depreciation within a 5-year period. So you can take it all in the first year if you want to, but you have 5 years to actually take it. So you don't have to take it all at once if you don't want to. It just depends on what your finances are and what you come up with your tax expert. So, but it's a fantastic thing. And then when they do the cost segregation analysis, they're taking all of the little things throughout the property and depreciating those as well. So for instance, carpets aren't going to last more than a few years. So you can depreciate that pretty heavy. A roof is going to be depreciated over 20 years. So you take that and you can depreciate that out. And so you're taking each of those individual things, and you're able to, through this cost segregation analysis, create a lot of value for the people who are investing passively in the deal. So for instance, the first deal that I invested in, I invested $115,000 into a deal. The K1 statement that I got back for my depreciation in the property, and so this is a paper loss, is $103,000. So I nearly got all of that money that I actually put into the deal. I can count almost all of that as depreciation and as a paper loss. So I can count that against my income and things like that. So is pretty powerful.
What size building was that? Like what size like project was that?
Yeah, so that one I believe was 170 units.
Okay.
So a lot of your operators that you can invest passively with, most of their deals are going to be in the above 50 units. So because any smaller than that, and it doesn't take many people to actually put together the capital necessary to take a project like that down. So but when you start talking about properties that have substantial numbers of units, then you've got to start bringing additional capital in from outside. So the deals that I'm invested in are, I've got a 55 unit, and that's the smallest that I'm invested in. There's an 82 unit, and then all of the others are between 115 to 215 units.
Which states did you say that you were invested in? And no, you said there's 4 different. You're over 4 different states.
So I'm invested in 2 offerings in North Carolina. So one in Raleigh and one in Lake Norman, which is just north of Charlotte. I'm invested in 2 that are in South Carolina. I happen to live in Winston-Salem, North Carolina, so I know the area pretty well, and I've been able to make some connections with operators in the area too. But 2 of the deals are in South Carolina in the Greenville-Spartanburg area. And then the other 2 deals, I've got one that's out in Colorado Springs and another one that is in Boise, Idaho. So my philosophy for investing is that I like to diversify my apartment portfolio as well as my stock portfolio. So, I mean, I invest in, index funds so that I have that full variety. But then I also, with my apartments, I invest not just in one location. I like to invest in different areas that are all booming for different reasons. You want to look at population growth and job growth and, all those kinds of factors. But then I also, aside from investing geographically in diverse areas, I also like to invest in different classes of apartments. So, I've got 4 investments in Class A properties and 2 investments that are in the lower B to high C apartment class rating. So, the Class A's are kind of the more expensive, higher amenities, but it's people that have really good, steady jobs. And, particularly during this downturn, these folks, their jobs, they've been able to go remote or, things like that have helped them, not to have any problems with being able to pay their rents and stuff. It's some of the B and C class that have actually had a little more issues with people having trouble, because many of those jobs were restaurant jobs and things like that, retail, that have just tended to go away during the coronavirus. But even so, the vacancy rating, vacancy rates have only dipped into the 80s. And most break-even points for apartment buildings are more in the 60s. So you can have, 60 to 65% occupancy, and you can still cover all of your debt service, all of your expenses, things like that. So.
Well, that's good to know.
Yeah. So it's, and I compare that to the scalability of single family rentals. So really, when you start talking about having a portfolio of single family homes, you really need to get to about 4 or 5 of them before you can start having vacancies that don't hurt you. If you have 2 homes and one of them is vacant, well, all of a sudden you're losing money. You can't cover the mortgages on both of them with just the one. So you really need to get to 3 and preferably 4 or 5 before that's no longer much of an issue. And the nice thing, like I said, with these apartment buildings that we're invested in, if you have a 100-unit building, that means you could have, 15 vacant units and you're completely fine. You can have 30 vacant units and you're still just then approaching your break-even point.
Hmm.
So the economies of scale are pretty powerful.
Yeah. Okay.
So.
Do you have any questions?
So you said that the investment is in the LLC that owns the apartment building?
Yes.
And is there, is the LLC, so would it be a different LLC per apartment building depending on where we choose to invest?
Yes, it would be.
Yeah.
So you would have to basically, when you're going through the process of investing, you're going to have to sign paperwork for the private placement memorandum, which is basically the legal paperwork talking about the structure of the company and how it's made. Because when you're talking about the company and it has limited partners and general partners, the general partners have a certain percentage of the partnership. So let's just, for simplicity's sake, let's say the general partners own 30% of the LLC. The limited partners would then have 70%, but the general partners have all of the control on their end. And that's kind of where that comes into play. But you have all of the different legal details in the operating memorandum. And so you would sign that and, sign the subscription agreement and all of those kinds of things.
And does that also include clauses around, what may happen to the building, like if it gets sold at a certain point or natural disaster or anything like that?
So what it does is it goes over all of the risks involved with the investment. With any investment, you risk losing everything. I mean, that's just the nature of it. But that being said, the actual idea of losing everything is pretty unrealistic, considering that you have insurance that you purchase. You still own the land that you're buying the building on. So just things like that kind of make it, I mean, it's pretty unrealistic to think that you would lose your entire investment. Now, what's more likely is that some kind of a natural disaster would really delay returns or prevent you from getting the returns that you expect in the time period that you expect them. So let's say, you get a hurricane that comes through and wipes out your entire building. Now you're going to have to go through the insurance process to replace that building. And that's going to just take a ton of time. So you're not going to get the cash flow that you were expecting. You're going to hope to get, just your lump sum investment back as soon as they're able to. And hopefully you would be able to put up a new property, you'd be able to get people in, but all of that stuff would take so much time. And so when you're talking about these kinds of investments, it's just something that, like I said, they go over all the risks involved and things like that. But that's a real rare kind of an occasion. It's sure, you've got people that are in a building and maybe they don't take as good a care of it as you would your own home, and they leave, they start a grease fire and a unit or two or something catches on fire. That can be fixed pretty quickly, but it's just different things can happen. You never know.
Yeah.
But
okay.
That being said, I mean, it's a relatively safe investment when you talk about the steadiness of the returns and the reliability and the value that's inherently in the assets themselves. Did I scare you off now?
No. I think it's more realistic. Yeah. No, it's good information to know because, like you said, there any investment you make, there's a risk of losing it all.
Yeah.
Um,
Yeah. So, yeah. And I mean, I don't want to tell people, hey, this is the end all be all, you know, I mean, you can make money or lose money with anything. You know, I have some friends here in town and they invested in a company that's incredibly reputable. They are super well known, and they ended up having, you know, just problems with the particular investment that they purchased. And it was a learning experience for everybody. Everybody got all their money back, but they didn't make all the returns that they were expecting to. And it was, you know, the key with those things is you want an operator who's going to be honest with you, and they're going to tell you what's happening along the way. If you're not getting regular reports from an operator or anything like that, then unfortunately you've probably chosen the wrong operator. You know, and at that point your money's your money's with them. So you just hope that things go well. But you know, that's where it's so important to invest with good operators as opposed to just looking at a deal's numbers.
So what made you go this route?
Well, so
did you hear what I said or no?
Yeah, I heard what you said. What made me go this route?
Yeah.
So part of it was I looked into a ton of different side hustles and things to make money, and at the end of the day, what was really valuable to me was my time. And so you know, I tried to let me just admit somebody here. What I tried to do was find different ways to create passive income. And so I initially I went the single family rental route. And I you know, my idea initially was, hey, I'm going to do a turnkey property. You know, it's something that's been newly rehabbed, good area, should be fine. And I just chose the wrong investment. It was not a good investment for the better part of a year, because I had the wrong property management team, and it went south for a very long time. So it took me about a year until I actually started making some money on it. And but on top of that, it wasn't even that necessarily that headache. It was more so the process of like going through the banks and having to re-up everything. You know, okay, well, this is taking a little longer to actually get the deal to go through. You know, with I invested in my first multifamily property. You know, I basically got the paperwork, I signed it off, I wired them the money, and I was invested. And that was all there was to it. And then 3 months later, I started receiving checks. So I was receiving checks on that much quicker than I was receiving checks on my single family rental. And so when it was that easy, I just said, okay, well, this is what I'm doing. And I've looked into all kinds of stuff. I've looked into options investing. I've looked into wholesaling properties, you know, doing the corporate rental / Airbnb kind of thing. I almost jumped into that actually last winter, and then COVID hit. So I was like, okay, well, good thing I didn't do that. I could have gotten myself in some trouble there. But you know, just there are all kinds of different ways to do this. And what I've figured out is that passively investing in alternative investments outside of the stock market is just, it's such a cool way to go. And it's not just multifamily. You've got self-storage, you've got ATM funds, you've got real estate notes, all kinds of things that you can invest in passively that will produce income for you. You know, without you necessarily having to stay on top of an investment and be worrying about vacancies and all those kinds of things. So I just found that to be incredibly freeing for me.
I'm curious about this. So I have another question about the apartment building investment. If the building raises rental rates, does the percentage of that profit come back to the investor as well?
Yes. So the big difference between apartment investing and single family investing is, if you go look at the same house, but it's in two different areas, it could be a difference of $100,000, $200,000 in price, right? I mean, if you're in, a nice suburb versus, the wrong side of town, the prices are going to be very different. Whereas in apartment investing, it's all about the net operating income, what you're actually producing from that property. So if that property is producing a certain level of income, the price is a direct reflection of what you're producing in income, and how low your expenses are in relation. So, and that's the big difference. You could have a home that's $300,000, but you can only really rent it out for $1,000 a month, versus, an apartment building. It's like, okay, well, if you've got 100 units and you can rent them all at such and such price, that's how the price of the apartment building, that's how they arrive at the price, is by looking at how much you can actually charge in rent. So when you're looking at an offering, you want to see that there is room for rental increases. So regularly you'll see a deal and you'll see that, okay, well, the people that owned the property beforehand, they didn't fix up some things. And as such, their rents are about $150 a unit lower than the surrounding, buildings. So you want to make sure you do a proper rent analysis around your area and really figure that out. But, the idea is that if you can put a little bit of love into a property and then you can raise the rents up to just market rent, you want to make sure your operators aren't saying, okay, well, we're going to go to the high end. That's where we're going to go. And it's like, no, that's not giving you any room for error if you do that. But if you're dealing with conservative underwriting by the operators and they're looking at it and saying, okay, well, we just want to bring it up to where the rest of the market's at. That's all we're wanting to do. And right now we know this property is well below those market rents, then you can all of a sudden drive value so that when you sell that property, that's when you get the money for that. So you don't necessarily get it along the way in your cash distributions, but in the sale of the property, now you let's say you bought a $2 million property, but when you go to sell it, now it's worth, $2.75 million because you were able to drive up rents. And now that property, you can justify the cost. Does that make sense?
Yeah.
Okay.
So you said 6 to 8% cash flow is pretty normal. You don't typically hope for more than that.
So there are deals that actually have two different types of limited partners. So there's the one that is the 6 to 8%. Sometimes it's 9 actually. So 6 to 9%. And then you get to participate in the upside of the sale at the end of 5 to 7 years, whatever your time frame is. So that's one type. And then the other type will be those that maybe they are offered 10% cash returns, but they don't get to participate in the upside at all. So it doesn't, they just get 10% throughout the time that they hold it, and then they get their money back at the end, their initial investment back at the end. So you can mix and match those. So a lot of times if a deal is offering both of those, you can say, okay, well, I wanted to have 50% of my investment be in this one and 50% in the other one, so that you still get to participate in the upside, but you don't have to, you're going to get higher cash flows throughout. What I like to look at for myself personally is I want to get as much of my money back as quickly as possible. And there are two ways you can do that. Some of it, the first way is obviously with the higher cash distributions. The other one is through a cash out refinance, which most operators will try to do within the first 2 to 3 years of a deal. And so that is a non-taxable event. You'll regularly get, 50 to 60% of your initial capital back and then you can reinvest that into another deal. And so you start the snowball then, you know. So now instead of basically having a basis of say $50,000 that you've invested, now you've got an investment that's, you know, based on $75,000, $85,000, you know.
Huh.
But
Mhm.
Travis, how you doing, buddy?
Great. Sorry. Yeah.
That's
Caught me off
okay.
guard. Yeah. Thank you
Yeah.
for throwing. I just realized this was going on and thought I'd jump in.
Yeah, absolutely. You're welcome. It's you know, glad to have you.
Yeah. So sorry, I'm just kind of catching up. Are you kind of putting these deals together, or are you just kind of jumping in on them, or what's your role?
Yeah, so the deals that I'm invested in, I've just kind of jumped in as a passive investor. But however, the business that I've got now, On Call Capital, the idea is that I have these operators that I've developed relationships with, and they've got proven track records. And so, you know, they can present their deals to me. I can look over them, and then I can present those deals to investors, you know, and other CRNAs. That's my goal, you know, is to help other CRNAs see that, hey, there's some value here. We can, you know, you can create side income, you know, on the, you know, side income on the side, you know, stuff that helps you out, so you don't have to you can create the lifestyle you want. That's what it's all about, is the flexibility to do kind of your own thing. You know, if you only want to work 3 days a week, then this can allow you to do that. You know, so stuff like that. But that's my goal, is to be able to provide not just multifamily investments, but like I said, all different alternative investments as well. Self-storage, mobile home parks. You know, I kind of want to run the gamut and just, well, I want to listen to other CRNAs, see what they're comfortable with. But, you know, my idea is diversity is a good thing. And, you know, the markets shift. It's not always the best time to invest in multifamily. It could be a better time to invest in mobile home parks or ATM funds, or whatever the case may be.
Yeah. Okay.
So, but yeah, that's my goal, is to help educate people on what's out there. I like, you know, my plan is to have some offerings available in the future, and, you know, hopefully be able to get some people involved on those and help some people out.
I know, I can't think, when you were jumping in, you were kind of talking about funding a little bit. Just curious, like, how difficult do you find it are you guys funding like an initial deal? Let's just say in $1 million deal. You know, are you putting like 20% down, 5% down, like nothing down? Typical, how is that usually working for, let's just say $1 million, you know, 100 units or something like that?
Yeah. So, in that instance, you would put, you know, probably 20 to 25% down on the loan, but then you're also going to need, money for capital expenditures, you know, for your improvements that you're going to make to a property. So most of the time you're going to raise anywhere between 40 to 50% of the actual purchase price. So, you know, for $1 million property, you'd probably be looking to raise $400,000 to $500,000. It depends on how heavy of a lift you've got, you know, with the fix and flip part of it. But, you know, that's a ballpark.
Okay.
Yeah. So, because the whole idea too is that you want to make sure you're working with people that are able to fully fund a deal. So it's one thing to just be able to get the loan, but if you can't get the capital to actually carry out your business plan, then it just doesn't work out as well. So, you know, when you have, and I think I mentioned it earlier, that, you know, your deals that are smaller are able to be taken down by fewer people. So you don't end up needing a whole lot of extra capital from other people coming out. But when you start talking about those bigger deals that are above 100 units, you know, or in really, you know, nicer areas or whatever the case may be, that's when you need to have outside capital coming in and have those limited partners. Otherwise, if you're just buying a 20 unit building, for the purchase price is 500,000. Well, gosh, that'd be low, but,
Mhm.
but, let's say it's $1 million. So then you really only have to raise $400,000. Okay. That's not a whole lot to raise. You could get, 4 to 6 people together and kind of cobble together $400,000. And then you could carry out a business plan, and then everybody would benefit from having that full share of that deal. So, but it's your bigger
So
deals that typically need capital raising. Go ahead.
Yeah. And I think you were kind of hitting on it earlier. So in a deal like that, and you were saying that 6 to 8% or 6 to 9%, if you're just getting it like monthly or whatever, your cash flow, versus, and I might have missed it. If you wait your 5 years, if you're just taking let's say 6%, on your monthly cash flow essentially, and then sell the property in 2 to 4 or 5 years, whatever.
Yeah.
So if you're increasing the on that $1 million property, now it's worth 1.5. Let's say you got 5 people in that deal. So are you typically splitting that if you had 5 people in the deal, would that be 20% type of thing?
So if you're talking about just a general partnership, then it would be probably dependent on, everybody's roles within, and how much capital they brought to the table. If you've got 3 people that just brought in $50,000, but they're not really doing anything except that they helped you raise a little bit of capital. And then the other folks put in, 100,000 each, and they're doing all of the work, then they're probably going to negotiate that they get a bigger share. When it comes to a bigger deal, like a 100 unit that costs, $5 million to purchase, now you're talking about general partners and limited partners. So for instance, a common format for that is 30% goes to the GP and 70% goes to the LP. Okay. And that can shift as you reach certain return markers. So once the limited partners hit 12% returns, then all of a sudden it can shift to more of a 50-50. Now, the important thing to keep in mind with all of this is that the goals of the general partners are aligned with the limited partners. They do, you do well as they do well. If they can't carry out the business plan, they're not raising the value of the property, they're not going to do well, and you're not going to do well. So the way they structure these is to make sure that the investors are taken care of. So a typical deal is one that you're looking for your money to essentially double in 5 years. That's kind of the benchmark. That's the goal. You want to have your money at least doubling within 5 years. So when you look at a property, you want to look at what's called the equity multiple. Okay. And all that means, if an equity multiple is 2x, that means that your money is going to double within that hold period. Okay. So you'll see it at 1.92, you'll see it at 2.08, whatever the case may be, but you want it around that 2 level. And then you want to take a look at, how those returns actually come out. Is most of it in the sale, or is it really spaced out among the cash distributions, because you're getting 8% or 9% returns on your cash instead of just 6. So it depends on the deal itself, but that's kind of how they're structured. The overall returns, they're looking for 14% or better per year. That's essentially doubling your money every 5 years.
14% compounded, or because
it's equal. So if you took 14% compounded, it would be a 1.96 equity multiple.
Okay, that's beyond me.
That's okay. It's
Yeah.
and the thing, so the investments themselves, apartments, your money's not compounding, but the
Mhm.
returns are equal to that of a compounding return.
Okay,
Does that make sense?
a little bit, yeah.
So if you were to take a $50,000 investment and it was going to be worth $100,000 in 5 years, you would have to make a little over 14% compounded returns to get there.
Yeah.
An
Okay.
apartment investment is working with non-compounded returns, but still getting you to that same place.
Gotcha. That makes sense. What you said, that was a 1.96.
6, I believe.
And what was the
I-
other thing you said? What is that? The last, what is that called? 1.96
Oh, that's the equity multiple.
equity
So
multiple.
yeah, the EM is what you'll see. So Ryan Johnson put up a deal on the CRNA, I think it was the real estate page. And if you guys want to take a look at that, that'll give you some of these different numbers. And I believe his equity multiple was 2.01, or 2.08. And so, which is, that's a good return in this environment. And so, what I'd want to look at there are, okay, well, what are your cash distributions and how much of this is dependent on the sale of the property, because what I was looking at is, I believe the rents, he said they were, $150 to $175 below rent, or, below market rent. Well, that gives you a lot of wiggle room, and you can probably hit that pretty quickly out of the gate, depending on how much rehab you actually have to do. So you can really improve the actual, property value pretty quickly with something like that, if you just move them up to market rent. So, but yeah, that's a good deal, a good one to just take a look at if you get a chance, since it just happens to be out there. So one of the things too is, I've got different types of deals. So there's 506B and 506C deals. So Ryan's deal that he put out there is a 506C deal. Okay, and that just is the SEC regulation, that it pertains to. But the difference is that a 506B allows people who aren't accredited to invest. So you'll have accredited investors and you'll have sophisticated investors. So an accredited investor is somebody who makes over $200,000 a year, or $300,000 jointly with their spouse, or they have $1 million in net worth. So in order to be an accredited investor, those are the qualifications. And with a 506C deal, you often have to go through a process of verification for that. With 506Bs, you do not have to go through a verification process, because they will take up to 35 sophisticated investors. So those are people who don't have that accredited investor status. Either you're not making that much money, or you don't have that much value, net worth. But they have 35 slots per deal that you can invest in. The difference is that you can advertise a 506C anywhere you want to. You can have the little advertisements that come up on the side of Facebook pages and everything else. So, and that's the kind of deal that Ryan's put out, is an accredited investor deal, a 506C, because he's able to just, throw that out there. And that's because there is a verification process involved. 506B deals, you cannot advertise. So you have to be on, have an actual relationship with the person who's offering that deal, in order to invest. So a lot of the deals that are out there are 506B. You won't see them unless you're on a specific operator's subscriber list and you've had a conversation with them over the phone, or like we're having in person. I'm able to kind of get to know you guys a little bit here as well. We've got about 10 minutes left, and I would like to touch on that a little bit. Get to know you guys a little bit better. But that's kind of how it works with these different types of deals. So Does that make sense? All right. So where are you guys at? And what's the experience level here?
So I own a property, just a single family property that I rent out on the East Coast because I'm from the East Coast.
Okay.
And as I said, we were just talking about this morning about different ways of starting to produce passive income. So we're just trying to explore all the different options. I've invested in some startups and yeah, just not a lot. We've been thinking about real estate, but just the thought of actually operating and managing a property is not majorly attractive to me.
Gotcha.
No.
Me either.
Like that day-to-day stuff. Yeah. So like that day-to-day stuff is just not really very attractive. So
yeah.
And we're in Seattle.
Okay. Cool town. I was there for the conference back in, gosh, was it 2010 or something? About a decade ago.
Yeah, and then there was another one in 2017, I think, because that was the first time I was in Seattle, and then I moved here like 2 years later.
Oh, nice. So, nice. Yeah. Cool.
Yeah.
So
and I'm mainly invested in cryptocurrency, but I'm recognizing we've got a baby on the way, and we're looking to stabilize a little bit. This crypto is a little bit volatile.
Just a little bit. but I tell you what, it's turned out well for a lot of folks. So, and I consider that to be part of a diversified strategy. You know, if you can have, you know, a certain percentage in that and just let it ride. It's not a bad idea at all.
Yeah. And I don't want to be a slave to the hospital either. So
yeah,
that's ultimately
cool.
Diversity is key.
Yeah, absolutely. Cool. Well, how about you, Travis?
Trying to get into real estate for probably the last 5 years or so. Just started a partnership with someone here. I'm in Michigan, Kalamazoo.
Oh, nice. All my in-laws' family are up there. We'll be up there this summer, hopefully, you know. So they were in Lansing. Not Lansing. Gosh, what is the town now? Onondaga. It's a small little speck, but it's about 40 minutes to the west of Lansing. So all of them are Michigan State grads, and so Grand Rapids, Holland, Detroit, all over the place.
Close to us, so we're close to GR. So so started a partnership with he's a real estate guy here in town. He's a contractor and a realtor. I really, really enjoyed the pursuit of finding properties. He enjoys fixing and flipping them, which, you know, I don't have time for that right now. But I really do. Like, my wife's been driving for dollars. I've been really like loving the putting the deal together part. I have a lot to learn. But yeah, we bought 2 properties the last day of the year, and we just sold one. We did nothing to it and had like a 50% return on that.
That's nice.
Essentially just wholesaled it. Yeah. So then it fund the other property. And that one's it's probably a month away from being rented. And then we're working on a land contract right now. And then we'll the first property, we'll just burr it and try to buy something else hopefully in July.
Nice.
Yeah.
Cool, man. Yeah. I mean, you know, and I don't have any problems with single family. It's not, you know, it's just not my thing necessarily. But man, so many people have so much success with it, and you know, especially when you start talking about the fix and flip stuff, if you can find the right deals and you can put in the time and energy to it, you can really do very well.
Yeah. But the reason I logged in tonight was because I read the whole I am interested in bigger deals eventually, and it's something I know very, very little about. But right now I have no capital, so it's all burn up. But I am interested in just, you know, learning how to do it, and that's how I got into real estate as well, was just funding, like, you know, $60,000 properties that they fix and flip, and I just made my little 10% return on it and enjoyed that. So yeah, so
Nice.
I'm not totally against funding something like this. It's just probably not the right time for me.
Cool. Well, so with either one of you guys, are either one of you guys, you haven't received my educational series, have you? My email series? You guys just found me on Facebook just now, right?
Yeah, it just
Okay.
ended up popping up in my feed, and not
Cool.
this group doesn't always pop up. It just happened to, and yeah, so it
Yeah.
just was good time.
Okay. So if you guys want, you can just email me your addresses if you're interested. I've got a free educational series. It runs over, several weeks, and it's an introduction to apartment investing and, the ideas behind it and different terminology and stuff like that. So, just something to help you guys along your journey. If you're interested, and then you can also, you'll get my newsletter. I put out a monthly newsletter with updates and stuff. I've just started a YouTube page where I'm going over some different terminology, different things within apartment investing. So short little, 2 to 3 minute clips, and you can learn a little something that maybe you didn't know. So yeah, just stuff like that. If you're interested, I'm here to help people out and be a resource. That's my goal. So you're welcome to it. If you just shoot me your email address, and you can get it started. I'll get it sent off to you. So
Okay. So just email
Absolutely.
it, Bobby at All
Yep.
Investments.
Yep, that's
Okay.
it. So yeah.
And then you had mentioned that you got started on this journey by listening to like the Michael Blanc podcast. Are there any other resources that you recommend just like checking out for more information other than obviously your educational?
Yeah. So let's see. I guess it depends on so Bigger Pockets. I mean, they have some great stuff, that you can purchase. Let's see. I'm going to sneak behind the curtain here real quick. I just got a green screen because I'm going to start podcasting, and this is, so it's all part of the process, but I got to look back here. Hold on. Let's see. Yes. So one of the books that I have that's a great one is it's called The Perfect Investment, and it's by Paul Moore, and you can find podcasts with him on them, and he does a lot of podcasts and stuff, and it's an older book, but it goes into a lot of the tenets of apartment investing that I think are important, and he's able to kind of write about it in not so dry of a way. There are other books out there that are just kind of, got to go through all the terminology and stuff, but he's, fairly entertaining with the way he tells stories and things. So, and he's got, he's an older gentleman. He's got a lot of stories. He's been in real estate for a long, long time. So, I think that one, The Perfect Investment, and, but even now, like he'll sit here and say, well, maybe multifamily is not quite the best investment right now. Maybe it's something else. And that's where, like it was great 7 years ago because everything was on sale, and, and there wasn't tons of capital. Now there's tons of capital flowing in. So there is a lot of money and a fixed amount of, assets. So, and until we, start really building a little bit more, it is going to drive the prices up. Now, that doesn't mean you can't do very, very well. I happen to think that 14 to 15% returns are pretty doggone good. But, he's comparing it to when the returns were 20 to 25%. So, you can look at self-storage right now. Self-storage is starting to get a little overheated. But there's still plenty of room in secondary and tertiary markets where it's looking good. And it's the same thing with the apartment stuff. So yeah. But as far as podcasts.
Yeah, my first property that I bought was
I'm sorry.
Any more podcasts? No, go ahead.
Oh,
Give me a
well,
podcast.
so Jake and Gino, their podcast is good. You know, and I like Michael Blanc's as well. He's gotten to where he talks a little bit more about passive investing now. Let's see what else I got here. Diary of an Apartment Investor is a great one. My buddy at Four Oaks Capital does that one. I was a guest on that one as well. But he does a really good job. He matches basically a new investor with an experienced investor and has them kind of, you know, asking questions and figuring some things out. So it's a really neat one. Let me see what else I got in the library here. I listen to a lot. So, if you want to get into nitty gritty, if you want to get into, you know, some of that technical stuff, the Cash Flow Connections real estate podcast with Hunter Thompson, he's excellent. He is really excellent. You will not find just better technical analysis than you'll find there.
Okay.
So, and I've probably given you enough to go on from there.
Yeah, no, that's fine. Yeah.
But
I was just saying this morning that we need to change up our podcast listening if we want to start exploring this route.
yeah, and there's a lot of good ones out there. There really are. You know, and of course there's, you know, Joe Fairless and stuff like that out there. And I mean, it's nothing against that. I think they do a great job, but I mean, some of these podcasts, you know, not everybody's got an hour and a half to listen to a podcast. You know, so if you can get a podcast that runs about a half hour, I'm good with that. You know, let's get the info and move on to the next one. So,
yeah,
but yeah, so I do see that it's 9 o'clock. Did any of you guys have any other questions before we kind of wrap up here?
I don't think so.
Just got to make sure. I'm looking on my phone. It's tiny. Is Bobby?
Bobby at oncallinvestments.com.
Awesome.
Yeah. So, and like I said, you can find my YouTube page. If you just go look up On Call Capital on YouTube, you can find the YouTube page, and it has, I've got last month's meetup recorded on there. Maricela Soberanes and also Ryan Johnson were on there last month. So, you know, they've got a lot of good information to share and a lot of experience as well. So that was a really good meetup. But yeah, so
sending an email now.
Oh, perfect. We'll get that going. I'll get you started on that process there. So
great. Thank you very much.
Awesome. Thank you guys. Yeah. And
Yes.
you know, I'm glad it was helpful for you. And if you guys ever have any questions, you know, just shoot me an email. You know, I'm wide open and happy to be a resource.
Great.
So,
thank you.
all right. You're welcome, guys.
Thank you.
Have a good night.
You too. And
Bye.
take care.
Take care.
Thank you so much for joining me for another episode of the Plan B CRNA podcast. If you haven't already subscribed and reviewed the show, I'd be honored if you took the extra time. It really helps to expand our reach and get the word out about the show. If you're a CRNA who is interested in sharing your story on our podcast, I'd love to have you. Please email me at bobby@oncallinvestments.com for more information. This episode was brought to you by On Call Capital. They are dedicated to helping providers like you develop passive income and generational wealth through investments in the apartment and alternative investment spaces. Feel free to check out their website at www.oncallinvestments.com and subscribe to their free educational email series. You can find On Call Capital on Facebook, Instagram, and Twitter. You can also check out our YouTube page, where you'll find all of the show episodes along with other educational videos. Thanks for listening, and we'll see you on the next episode.